Hello everyone, my name is Kamal Manocha. I am founder and CEO with PMSAF World. We have been running this series by name Advice Sense webinar series. This is knowledge series where the broad topic of the series is crystal gazing next decade of wealth creation for investors. So in this series, we have invited all the prominent fund managers from the portfolio management industry to come and speak about their views with regards to what are the challenges, what are the opportunities with regards to investing over next 10 years, the next decade, which is 2020 to 2030. The last webinar that we did was Mr. Hiren Ved, where we had covered leaders of tomorrow. In this webinar, we have Team Marcellus, where we are going to cover their view on financial services sector. They have launched a new product, a new portfolio in the name of Kings of Capital, which is particularly focused on financial services. And we have amongst us three prominent guests from Marcellus Investment Managers, Mr. Pramod Gabbi, who is the head of sales, Taj Shah, who is the portfolio manager with this particular strategy, and Saurabh Mukherjee, who is one of the co-founders and is also the chief investment officer with Marcellus Investment Managers. Saurabh will be joining us in next 15 minutes. In the meanwhile, I'm going to hand over to Mr. Pramod and Taj for them to start and set the context. Over to you guys.
Thank you. Thanks, Kamal. It's a pleasure to be on PMSAIF platform. So we've had a special relationship for long. We've had all our strategies being present on the platform pretty much from day one. So it's great to be here. And thank you to both PMSAIF and all your viewers and clients for all the support to Marcellus so far, and hope you'll continue to extend the same going forward. So with that note, I'd like to begin. The Kings of Capital portfolio obviously is a little bit of a contrarian stance. As you might have heard, several portfolio managers and CIOs across the country have expressed their concern about the financial sector, perhaps rightfully so, and therefore have taken significant underweight positions, again, rightfully so, given their strategies, given their philosophy and the audience. Why then has Marcellus gone out on a limb to say that this is the best time to get into financials? Only difference is we are saying that not all financials are made alike. We are looking to get into the highest quality financials. And throughout the next 60 to 90 minutes through our presentation as well as Q&A session, we'll explain to you why we believe the best time to invest in the high quality financials is during the crisis. And to do that, no better than our fund manager of this portfolio, Tej Shah. I'll have a quick introduction of Tej himself before I'll hand it over to him. And by the time we come to the macro section, which is also an important driver, by the way, the whole financial services sector is known to be a leverage play on the economy. And therefore, we need a clear view on the macro, and no better than Saurabh himself to talk about the Indian macro, particularly at turning points like these. Just a quick intro of Tej. Tej has been with us pretty much right from the start. He's been responsible for all our financials position across all our portfolios, whether it's consistent compounders or little champs. He's been with us like many of Marcellus team members from our Ambit days as well. He spent a couple of years at Ambit at the equity capital markets business, doing some of the marquee deals around IPOs, QIPs, and buybacks. He went off to Silicon Valley Venture Capital Fund for a brief while before he joined us back in Marcellus. Tej is a chartered accountant and has a BCom degree from Ahmedabad University. Tej, together with the rest of the research team at Marcellus, has been working on this portfolio for the last couple of years. And this portfolio has been built through research over this period. It's only when we got confident and perhaps a little bit of opportunistic in terms of launching the fund, because we found that the opportunity to be quite exciting in times like this. With that, I'll hand it over to Tej to take you through what we mean by why it's such an exciting time to look at a financial specific fund. Over to you, Tej.
Thanks, Pramod. I hope you can see the screen.
Yeah, we can see the screen. Go ahead, Tej.
Okay. So Kings of Capital is a financial services focused fund. And what we've seen over the past 6-7 years is that this is a sector which has seen multiple challenges. And every year, the challenge has been in some ways pretty different from what we've seen previously. It started off in 2014, 2015 with Raghuram Radhan's asset quality review. And then 2016, we saw demonetization. 2017, we saw introduction of the GST. 2018 was the ILFS crisis. 2019, 2020, we've seen DHFL, Yes Bank collapse. And on top of that, to make the situation even worse, we've seen the COVID crisis. So over the past 5-6 years, NPAs have doubled, more than doubled actually, from 3-4% to 9-10-11%. And what COVID has done is, in a situation which was already challenging, especially for the weaker lenders, it has put even more pressure on these lenders. However, paradoxically, it is in such a scenario, it is during a crisis like this, that investing in high quality stocks can prove to be highly rewarding. And storylines or headlines during a financial crisis like this are pretty similar. Comparisons are drawn to the crisis of the 1930s. The solvency of banks is questioned during a financial crisis, and NBFCs, they always see an existential threat during a crisis. People always start questioning whether NBFCs should even exist or not. However, we've seen that smart investors can make a lot of money by investing in high quality stocks during a crisis like this. So whether it be the 2008-9 global financial crisis, or the crisis of the late 90s, early 2000s, when about 80% of NBFCs got wiped off, we've seen that by simply investing in the bank Nifty, and it doesn't matter whether we invest at the lowest point 3 months before the lowest point, 3 months after the lowest point, we could have easily made 20-25% returns by investing in the bank Nifty. So that leads us to 3 questions that need to be answered. Question 1 is, how do we know that the crisis is bottoming out? How do we know that an Indian economic recovery is around the corner? Where do we stand in terms of our macroeconomic situation in India as of now? Question 2 is, even if we know that the crisis is bottoming out, how do we know which financial services stocks to invest in? What should we look at? What should our filters be like? What should we consider in terms of parameters to look at? Do we look at growth? Do we look at multiples? Do we look at management teams, etc., etc.? And finally, after getting 1 and 2 right, how do we know when to sell? What sort of a strategy is this? What do we do 3-4 years out? So we'll try and answer these 3 questions primarily in the coming slides, in the coming few slides. Coming to question number 1 on India's economic recovery. So what we have seen over the past 4 decades is that every time there is an American recession, it is followed by a period of Indian economic recovery. In other words, an Indian economic recovery has never happened unless an American recession has preceded it. So the chevrons in red on this chart represent periods of Indian economic recovery, while the area in gray in the background are periods of American recession. So this is not just a mere coincidence. There are a couple of factors which primarily come into play when America goes into recession. One is the crude oil prices crash during an American recession. So if you look at the orange line, which represents crude oil price in dollars per barrel, whether it be 1984, 1985, the crude oil price crashed by 50%. Same case in 1991, crude oil prices went down from $40 per barrel to about $20 per barrel. Similarly, 99, 2000, 2008-9 was even worse. Crude oil prices crashed about 70-80%, going down from about $140 to $40. And we've seen similar movement in the crude price this time around as well. So one is that during an American recession, we get cheap oil. The second is the blue line, which is on the chart over here, that over the past 40 years, we've seen that the US 10-year bond yield has been on a downward trend. However, during a financial crisis, because the Fed gets into action, starts printing a lot of money, we see a further accentuation of this downward trend. And therefore, cheap oil and cheap money become key ingredients to an Indian economic recovery. That give a straight 300-350 bips boost to the Indian GDP. And that ties into what happens in the financial ecosystem as well. So the financial ecosystem, the financial sector over the past 20-25 years what we have seen is that a period of crisis is followed by a period of economic recovery, a period of recovery in the financial sector as well, and that is followed eventually by a period of economic boom. And this cycle has repeated itself twice or thrice over in the past 20-25 years. However, it is important to note that not all types of lenders are able to recover from a crisis. So while many would perish during a crisis, some would recover. However, their recovery, though might happen over a period of 2-3 years, their balance sheets might get severely impaired, and they may not be able to recover in the same shape and form as they were prior to the crisis. And therefore, what we have seen is that whether it be HDFC Limited during the crisis of the late 90s, or whether it be a HDFC Bank during the global financial crisis, post a crisis during the period of recovery, these are the high quality names which are able to grow the fastest and which are able to gain market share very rapidly. So if we look at the chart or the table at the bottom left of the screen, what we can see is that during 98-99, NPAs for HDFC Limited doubled. NPAs doubled from 0.5% to 1%. And along with that, the P ratio came off from about 20 times to 8-9 times. However, what we can see is that HDFC Limited entered the crisis with ROEs of 16-17%. However, it exited the crisis with ROEs of 22-23%. And along with that, its growth went back to 25-30% post the crisis because it started gaining and rapidly gaining market share. So this was a time when about 80% of the NBFCs in the sector got wiped off. And during such a time, HDFC was able to grow 30-31%. Similarly, with HDFC Bank similar was the case with HDFC Bank during the global financial crisis. It entered the crisis with 16-17% ROEs, exited the crisis with 19-20% ROEs. But during the crisis, it also saw something similar to what HDFC Limited went through during the previous crisis. NPAs increased from about 1.5% to 2%. P ratio came down from about 29-30 times to 18 times. However, again, post the crisis, it started growing its loan book back. Its loan book growth was back at 20-25%. NPAs started normalizing. NPAs went down to 1%, and ROEs were back to 18, 19, 20%. And as that happens, we also see that the P ratio starts normalizing. So the reason that this happens is, as a lot of lenders, a lot of poor quality lenders, whether it be banks or NBFCs, they get wiped out. They perish during a crisis like this, or are not able to raise liabilities, or do not have enough balance sheet strength to grow post the crisis. These high quality lenders are the last men standing during a post a crisis like this. So these lenders are first of all able to lend to the borrowers of their choice. Second, they are also able to charge the interest rates that they would like to these borrowers. And as a result of that, the NPA ratios actually improve post the crisis. And finally, over a period of time, we see P ratios also start normalizing. So rapid market share gains post a crisis for high quality lenders, P ratios normalize, NPAs normalize. So coming to our investment process, what is our investment funnel? So we started off with 9,500 stocks. These are all stocks from the financial universe. These include banks, NBFCs, general insurers, life insurers, brokers, and asset managers. And we run these 95 stocks through our forensic filter. So this is somewhat similar to what we do in consistent compounders or little champs, our other two strategies as well. First of all, we try and eliminate companies which have poor quality accounting. So about a third of our universe, about 30-35 companies, get eliminated at the first stage itself because these are companies with poor quality accounting. And I'll take you in some more detail in the coming couple of slides on our forensic ratios, which are specifically designed for the financial sector. On the remaining 65 stocks, what we do is we run them through our capital allocation filter. So what we try and analyze over here is whether over the past 6, 7, 8 years, these companies have been able to sustainably generate returns on equity well above cost of equity. And again, about 35-40 companies get eliminated over here because they've been not able to generate returns on equity well above cost of equity on a consistent basis over the past 6-7 years. And the ratios that we use over here are, for example, whether these companies have been able to lend profitably, whether their net interest margins have remained consistently above 3-4%, whether they've been able to improve their net interest margins, whether their provision coverage ratios are adequate enough while we compare them to their peers, whether their ROAs and ROEs have been consistently well above 13, 14, 15%. And then we are left with a focused list of 23 stocks. And this is where most of the research team spends its time, spends its effort. And what we try and establish among these 23 stocks is we try and pick the stocks which have really high barriers to entry, which have a large sustainable competitive advantages, because of which they can sustainably keep on generating returns on equity well above 15, 20, 25%. And the way we try and do that is we speak to management teams. We, of course, speak to people who've been a part of the board of directors, people who are existing board members. But we also try and corroborate what they tell us by speaking to, for example, in the case of banks and NBFCs, branch managers, credit officers. In the case of insurance companies, we speak to brokers, insurance agents, actuaries, etc., etc. So that is how we've created a portfolio of 10 to 14 financial companies. It's a 12-stock portfolio to start off with. And these are companies which have cleared our forensic filter. That is, these are companies with clean accounts. Second, they've cleared our capital allocation filter. So these are companies which have consistently generated returns on equity well above cost of equity. And third, these are companies which have high barriers to entry. So to give you some more detail on our forensic accounting, what we've done is that we use a combination of 11 accounting ratios specifically designed for the financial sector. And on the basis of these accounting ratios, we rank the financial stocks from a D1 to a D10. D1 being the best score and D10 being the worst score. So some of the ratios that we use are, for example, we use a ratio which is fee income as a percentage of net interest income. And this ratio, for example, for a Yes Bank is at 54% versus for a Kotak it's at 28%. So this ratio is in the vicinity of 25 to 30% for all banks, while it is about 54% for Yes Bank, so twice as high as other banks. And what this tells us is that Yes Bank was trying to make its P&L look much better than it actually was. So it was trying to book a lot of upfront income in the form of fee income, while its asset quality could have suffered and did eventually suffer over a period of time. Similarly, contingent liabilities as a percentage of net worth, for Yes Bank, that was 23 times. 23 times contingent liabilities as a multiple of net worth, versus say for a Kotak, its contingent liabilities were 4 times its net worth. So using a combination of such ratios, we arrive at a score which is a D1 to a D10. And then what we've tried to do is we've tried to find out correlation between our forensic score and share price returns. So whether these forensic scores lead to actual implications on share price performance. So if we look at the chart at the bottom right, what we have seen is that if we would have created a portfolio of companies which is in the zone of quality, that is D1 to D3, and if we would have created a portfolio of companies which are in the zone of thuggery, then the returns would have been 10% on a CAGR basis for the portfolio in the zone of quality versus minus 25% for companies in the zone of thuggery. So this is a 30-35% alpha over a 3-4 year period. And this is without any manual intervention, just by using our forensic filters without using any qualitative filters. And to give you one more example of our forensic accounting model is DHFL. So this is based on the FY13 to FY18 financials of DHFL. They filed annual reports. This is well before DHFL's accounting shenanigans became public. And before FY18-17, DHFL was rated as a D10 on our accounting model. And there were primarily 3 red flags. The reason behind DHFL being rated a D10 were, number one, fee income as a percentage of net interest income was pretty high. So this is somewhat similar to Yes Bank. DHFL was rated the second worst on our forensic score, second only to Reliance Home Finance. The second red flag was treasury income as a percentage of net interest income. So again, DHFL over here was ranked the third worst amongst its peers. And the third red flag, what DHFL used to do is it issued thousands of crores of zero coupon bonds and NCDs, which were routed. The interest expense on these bonds and NCDs was routed through the General Reserve Securities Premium, that is the balance sheet, rather than the P&L. So again, all three ratios point towards making the P&L look much better than it actually was. So whether it's fee income, treasury income, or booking interest expenses through the balance sheet, what it did was DHFL's profitability, profit margins, NIMs, and ROEs looked much better than they actually were. And on the basis of these numbers, DHFL was able to raise more and more debt and more equity. And finally, coming to how our portfolio will be constructed, this is going to be a portfolio which will consist of lenders as well as non-lenders. 60-65% of the portfolio will be lenders, and 35-40% of the portfolio will be non-lenders. And the non-lenders would consist of life insurers, general insurers, asset managers, and brokers. And what this does is the non-lending piece in the portfolio adds a lot of resilience to the portfolio. So it reduces a lot of volatility in the portfolio. So while lenders have leveraged balance sheets, the non-lenders, whether it be insurers, asset managers, or brokers, are relatively less leveraged. So asset managers and brokers have no leverage, while life insurers and general insurers have relatively lower leverage than the lenders have. And if we were to even take the example of the COVID crisis, even though all of these businesses form a part of the financial services industry, these are pretty uncorrelated. So for example, during the crisis, the retail brokerage businesses, they grew their business by 70-80%. Profits, revenues, accounts opened, all of them grew by 70-80%. Similarly, in the case of general insurance, what we saw was that because 50-55% of the business comes from motor insurance, during the lockdown, they saw a drastic reduction in motor claims. And therefore, they reported their highest ever profitability, highest ever ROEs during the June quarter. Similarly, in the case of life insurers, health insurance, what we see is that typically post health emergency or a pandemic like this, the awareness for life and health insurance increases drastically. So in the month of July, we saw that life insurance premiums increased by 40% year on year. So despite being a financial services vertical, these are uncorrelated businesses relatively. And the non-lenders in the portfolio add a lot of resilience to the portfolio and reduce the volatility. So what we've seen over the past 2.5 years is that if someone would have invested on 1st April 2018 in the Kings of Capital portfolio, they would have generated a 12% return. And this is during a period of time where we have seen Yes Bank, DHFL collapse, where we've seen ILFS collapse, and we've also seen the COVID crisis. And along with volatility, which is lower than the bank Nifty, sharp ratios, which are better than the Nifty. And the reason that this happens is the table on the bottom left. Because of our core focus on the fundamentals, because of our core focus on accounting quality and sustainable growth and ROE, the portfolio at the portfolio level, the earnings CAGR over the past 5 years was 19%, along with ROEs of 19%. And when we compare this to the bank Nifty or the Nifty, the numbers are pretty dismal for these indices. 7% earnings CAGR for the bank Nifty and 1% for the Nifty. And therefore, the portfolio, even during such trying times, while these companies were able to grow at 19-20%, we believe that such growth rates of 19-20% are achievable in the coming 3, 4, 5 years. Coming to question number 3 on our strategy on when to toggle the portfolio, how do we know when to sell what? We've got 3 approaches to this. The first approach being that what we've seen in the previous crisis is that once we invest in the crisis in high quality financial stocks, even if we were to invest in the bank nifty during a crisis, we've seen that 3-4 years returns could be anywhere around 20-25%. And once we've seen that, what we can do is we can toggle the portfolio. That can also save us from the drag that happens on the portfolio 3-4 years out. The second way we've thought about toggling or looking at the portfolio 3-4 years out is when we see a large number of IPOs. What we've seen over the past 10-15 years is that whether it be 2007, 2010, or 2017, a large number of IPOs in the market during any year is usually followed by a large drawdown. So minus 51% drawdown post about 100 plus IPOs in 2007. Similarly, drawdowns in 2010, 2017. And a large number of IPOs or a large number of QIPs are a clear sign of a raging bull market. And another similar metric that we can track is when all types of lenders, whether it's a DHFL or a Yes Bank, are able to raise money from the CP/CD market at rates which are sometimes lower than the treasury bill yield. And this is again a metric which signals which is a signal of a raging bull market. So at a time like this, when all types of lenders are able to raise money easily, we can see that the competitive advantage of a HDFC Bank or a Kotak Bank temporarily is a bit lower. And therefore, what we have in front of us would be two options. Option one would be that we increase our allocation towards non-lenders in the portfolio. That is towards the asset managers, life insurers, general insurance, and brokers. Because like we discussed, the impact of an economic downturn on them is much lower. They are much more resilient businesses. The second option being that we can improve and increase our allocation towards the higher quality lenders in the portfolio, that is the HDFCs and the Kotaks of the world. And now moving towards what sort of companies that we hold in the portfolio, why we hold them. So we'll give you 3 case studies. One is Bajaj Finance, second is Kotak Bank, and third is HDFC Bank. And the reason that we hold them is these 3 companies obviously clear our filters. That is, they have high quality accounting, high standards of corporate governance. Secondly, these companies have over the past 10, 15, 20 years, we have seen that these companies have sustainably generated ROEs well above cost of equity, good underwriting over a long period of time. And thirdly, these companies have high barriers to entry. However, what is different in each of them is the way that they've developed barriers to entry, and they've done that in their own unique ways. So in the case of Bajaj Finance, in 2008 time when Rajiv Jain joined as the MD CEO, what they wanted to do was they wanted to find large profit pools where they could sustainably generate 20-25% ROEs and show consistent growth while generating such ROEs. So they narrowed down on the consumer durables financing business. And today, 10-12 years hence, the Bajaj Finance finances about 70-75% of all consumer durables financed in India. And what they've done using the consumer durables financing business is they've used that as a customer acquisition funnel. So once they acquire a customer through this business, that customer is sold multiple products, multiple loans. So such a customer will be sold home loans, he'll be sold lifestyle loans, digital loans, personal loans, and recently also gold loans. Once a customer is acquired, Bajaj Finance does not require any intermediary. It reduces their customer acquisition cost, and they can keep selling the same customer multiple products. What that also does is, when Bajaj Finance lends to a customer, their probability of default, the probability of that loan becoming an NPA, is much lower versus any other NBFC who would be lending in the same segment. Because they know what is the repayment history of the customer, they have a large data lake available of the customer, and they already have the customer onboarded for a long period of time. So 70% of all disbursements of Bajaj Finance are made to existing customers. And what they've done is, across multiple segments, subsegments, they've created large amounts of data pools, because of which they can analyze at an individual granular level whether they can lend to that customer or not. So to give you an example, in the case of SME, MSME loans, they've now got a 7,000-8,000 crore loan book, which is consisting of healthcare professionals and doctors. Because this is a segment which is much more resilient than the other subsegments of the SME sector, they've developed a large loan book over here. And what they've done is that there are about 10 lakh doctors in India, and Bajaj Finance has mapped out details of each of these doctors. And the data that they've mapped out is what college did the doctor graduate out of, what is his specialization in the medical field, which year did the doctor graduate out of, what part of India does the doctor operate out of, whether it's rural India or whether it's a Bombay, Delhi, Bangalore. And then they overlay this data with data on repayment history, data on CIBIL scores, data on which other banks do the medical professionals have their relationships with. And once they've done that, they have created about 600 clusters within the doctor segment. So these doctors, 10 lakh doctors, are divided into 600 clusters. And what that does is that they have a clear sign on whether they can lend to a specific person or not. That reduces customer acquisition cost, that reduces turnaround times, and that also reduces probability of default. So when we combine this strength on the asset side along with their strength on the liability side, they are able to easily raise liabilities amongst the best in the NBFC industry, easily able to raise liabilities at 5.5% consistently. That is a pretty high barrier to entry, which is pretty difficult to break for any other NBFC or new entrant which is coming into the market. Moving on to Kotak Bank. What Kotak has done over the past 20-25 years is that they've tackled multiple challenges by way of super capital allocation skills. So in the mid-90s, early 2000s, they entered into joint ventures with the global best players in respective financial services verticals. So they entered into a JV with Ford Credit for vehicle financing. They entered into a joint venture with Goldman for broking and investment banking. Similarly, they entered into a JV with Old Mutual for life insurance. And once they learned from these global players, they started giving each of these global players an exit. Once they got the banking license, all of these businesses became 100% subsidiaries. So today, all businesses are 100% subsidiary of Kotak, whether it's a life insurance or broking business, or it is a vehicle financing business. And another challenge that they had once they got the banking license was they needed to build a large diversified corporate loan book. And secondly, they also needed to build a granular liability franchise. So again, both of these problems were tackled by super capital allocation. So when in 2008-9, most of the banks receded from the corporate lending market, Kotak doubled down on its corporate loan book. It grew its corporate loan book by 90-100% in 2008-9. And on top of that, it grew it by an additional 50-60% in 10-11. And that is how today about 30% of Kotak's loan book is corporate loans, which is one of the largest segments of its loan book. Similarly, CASA, today Kotak is at a 56-57% CASA ratio, the highest in the banking industry. And this it has done over a period of 8, 9, 10 years, over the past 10 years itself. Developing a 56% CASA ratio, and over time it has also got down its cost of deposits. It started off with 6%, but it is now down to 3.5-4%. So again, great liability franchise, great asset side, pretty conservative on lending, and therefore amongst the high quality banks, Kotak is right up there. Finally, coming to HDFC Bank, this is a story which has played out phenomenally well over the past 20-25 years. Consistent growth of 20-25% for long periods of time, along with superb asset quality, 1-1.5% NPS consistently. And what they've done is, the reason behind this is their intense focus on systems and processes. And they've minimized risk in each and every segment that they've entered into. So whether it be vehicle loans, whether it be credit cards, or whether it be retail loans, they've not been the first ones to enter into these segments. They've been maybe slow to enter into these segments. However, once they've analyzed the risks, once they've entered into these segments, slowly and gradually, they've become the largest players in each of these segments. So today, Kotak has the largest presence in rural India. It is the largest retail lender. It is the largest vehicle loan financer in India, so on and so forth. And we get a lot of questions around succession planning. What happens when Aditya Puri leaves later this year? So we've been working on this issue for the past 8, 10, 12 months. And we've been speaking to people at the bank, people who've previously worked at the bank. What we've come to know is that because of this intense focus on systems and processes, even though an ICICI and Axis, what people have told us is that even though ICICI and Axis would have similar bench strength, they would be similar in terms of talent, but because HDFC Bank was able to focus on systems and processes, minimize risks, it was able to outmaneuver all of these banks. It was able to maneuver through multiple business cycles over the past 20-25 years. And we believe that at least for the next 3-4 years, HDFC Bank has multiple tailwinds in place. It will be able to easily gain market share and maintain its supreme asset quality over the next 3-4 years. Coming to the fund structure, we offer two options. One is a 2.5% fixed fees with zero performance fees. And second is 1.5% fixed fees with 15% profit share over a 10% hurdle. And the minimum investment remains at 50 lakhs. So yeah, that's it from my side.
Kamal, happy to take questions. Saurabh is also here. Saurabh, would you like to add anything from your side?
Thanks, Bro. Thanks, and thanks, Tej, for the presentation. Sorry for the delay in logging in. I think one thing I would like to just reiterate as to why are we bringing Kings of Capital to the market at this juncture in this COVID-stricken hour. Why didn't we do it 6 months ago? Why don't we do it 6 months hence, right? So if you step back and think about Marcellus's investment philosophy, what do? We do the same thing in fund after fund. CCP, LCP, KCP, it's the identical investment philosophy, fund after fund. Look for clean promoters, essential products and services, dominant franchises. What do we mean by dominant franchises? We like to see companies with high barriers to entry and companies who can go on to crush competition and build 40, 50, 60, 70% market share, ideally 90% market share. We like that, right? So we started working on this whole product 8-9 months ago, but we got really, really encouraged by COVID. We were really, really happy when COVID happened on 3 different fronts. Firstly, it's relatively clear that COVID will lead to consolidation in the banking sector, right? Why is it clear? You can see the data on the QIPs. Around 6 or 7 banks are raising all the money. The rest of the banks are going to be starved of capital. They will have write-offs after Morat. Obviously, the RBI's restructuring will give them some relief, but restructuring 6 months ka relief hoga. After that, they will have the write-off. And especially PSU banks are going to get smashed on their balance sheet over the next 2-3 years. PSU banks account for 65% of the loans outstanding in the banking system. Even if you conservatively assume that their market share drops to 50%. Remember, PSU banks don't generate any capital. PSU banks survive because people like us, all of us on this call, we get taxed. The government of India takes our money and gifts it to the PSU banks, and they then continue destroying shareholder value decade after. So that game is over. The government of India can't afford to take hard-earned taxpayers' money in a situation like COVID and with China breathing down our neck. That distribution of taxpayers' money to PSU banks, that era is broadly behind us. So even if you assume very conservatively that market share of PSU banks drops from 65 to 50% over the next 10 years, that 15% gain in market share for private sector banks, who will gain? Will Lakshmi Vilas Bank gain and Dhanlakshmi Bank gain? Somehow we don't think so. We think obvious beneficiaries would be a Kotak Bank and HDFC Bank and so on. So let's take one of the two. Let's take Kotak as an example. Kotak market share today is 3%. Even if the market share a decade hence is 5%, you and I will get comfortably 10-year pounding of 20% per annum, right? So straightforward consolidation in banking sector. PSU banks lose share, strong, well-run private sector banks gain share, and Kings of Capital makes money on the back of that. Secondly, let's look at the NBFC sector, right? So I think, Tej, would it be possible for us to have that slide again showing forensic accounting in the NBFC sector? So what Tej's slide showed you was something like 70% of India's NBFCs cook their books, right? So he's very politely called some of them in the zone of opacity and some of them in the zone of thuggery. So I think we'll just wait till yeah. So if you see the slide, look at the bottom left panel. What Tej is saying is 70% of India's NBFCs cook their food, right? Now these gundas, they had a business model. Business model till 2 years ago for the typical NBFC in India was first you call the credit trading agency CEO to your office and you give them laddus and jalebis and he gives you a AAA rating. With that AAA rating, you go to the mutual funds in Bombay and you have gulab jamun and chocolates, and the debt mutual fund takes hard-earned retail investors' money and sticks it in the NBFC's balance sheet, and NBFCs are in the zone of opacity, zone of. Right? This was the business model of the vast majority of Indian NBFCs. Right? Somehow get a good rating from a credit rating agency, then perpetuate the debt mutual fund, take hard-earned people's money and stick it in their wretched bank. This game has unraveled over the last 2 years. Last year, SEBI announced, and full disclosure, I sit on that relevant SEBI committee. SEBI announced that no more than a quarter of debt mutual funds' paper will go into commercial paper issued by such borrowers, right? Such issuers, such NBFCs. Right? That obviously cut the oxygen supply to some extent for the zone of opacity, zone of Nagari NBFC. Then this year in March, a prominent mutual fund announced that a good $5 billion of retail investors' hard-earned money could not be returned. The mutual fund conveniently blamed COVID, but that put the fear of God in other mutual funds who said, boss, we're not going to do this nonsense anymore. No more money for zone of opacity, zone of NBFC. These poor sorts have lost access to money. So market share will consolidate in the NBFC sector to that zone of quality. So we are happily invested in Bajaj Finance, and Bajaj Finance and other zone of quality NBFCs will gain market share, and we in Kings of Capital will make good money. That's the second consolidation dynamic. Third consolidation dynamic is what all of us are doing on this webinar. RBI has consistently said that 95% of India's wealth is in physical assets, real estate and being primary physical assets. India's wealth is roughly $10 trillion. That means only 5%, only $500 billion is in financial assets. Now, obviously, it's becoming increasingly clear to people in our social strata, everybody on this call, social strata, that you can't do nothing with physical assets. You can't pay for an exigency like COVID. You can't send your children to study in America. You can't fund your retirement with physical assets. Rental yield is 2%. Kya karoge? Right? So gradually, Indian families are realizing we need to have more financial assets. So let's again be conservative. Let's assume that over the next 10 years, financial assets go from being 5% of our savings in our country, 5% of India's wealth, to 15% of our wealth. That means we will add $100 billion a year for the next 10 years into financial assets. Now, who will benefit from that? Life insurers will benefit. A class life insurer like HDFC Life will benefit. Health insurers and motor insurers will benefit. A class like ICICI Lombard will benefit. Good asset managers will benefit. We are unlisted, unfortunately, but people who are listed, good asset managers who are listed will benefit. And obviously, good wealth managers and stockbrokers will benefit. So that's the third consolidation story, right? Demise of third-rate stockbrokers, the rise of high-quality, clean, well-run, technologically oriented stockbrokers. You consolidate stockbroking, you consolidate asset management, insurance, you consolidate banking, you consolidate NBFCs. Kings of Capital thus gives you a way to play the impending consolidation of the financial services sector, both on the lending side and on the savings side. The best banks, the best NBFCs, the best insurers, the best asset managers in a 12-stock portfolio consistent of clean market-leading franchises. Right? So that is the consolidation dynamic we are playing. COVID is perfect for that. The more blood there is on the street, the happier we will be, the more money we will make in Kings of Capital. So I just wanted to add that, and Kamal, over to you, sir.
Thank you so much, Saurabh. Taj, you can change the view, stop sharing the screen, and then we can start the questions.
Okay.
Right. First of all, thank you so much, Saurabh, for joining us and giving your perspective. So we have too many questions. The first question comes in a very practical manner. I had a discussion with Pramod also in this regards, but this question is coming from a lot of investors. So there are two types of investors, who have come to Marcellus over last one and a half years, right? One, those types of investors who have learned from you over last 1.5 years that most of the companies in Indian context are cooking their books, and you have created a portfolio which is a consistent compounders portfolio, which is a concentrated portfolio of top 1% of universe of those companies which are not only market leaders in their by owning the revenue pie, but also owning the profit pie, because they also own the pricing power, and because they are good B2C brands. Right now, we have equally good portfolio, which looks equally good or even maybe better than that, because this is in one particular sector, and since the ticket size of both is 50 lakhs, and since both products are available, one can choose any of these two products. So those investors who are already invested in consistent compounders, right? So how should they consider this particular portfolio? And those investors who are wanting to compare these two, right? What are the yardsticks that they should keep in mind, and how should they take their call in this regards?
Sure. So if it's all right, Kamal, can Tej show that slide where he showed standard deviation and 5-year returns? Is that all right? Can Tej
Absolutely.
Tej, if you could just beam that up, the standard deviation wala slide. So what we'll show you is performance over the last several years. If you look at this super slide that Tej has created, look at the bottom left table. Bottom left table is telling you that the Kings of Capital portfolio, which is best lenders, the best insurers and asset managers in India, earnings compounding over the last 5 years has been very similar to CCP, which is around 20. CCP, Rakshit keeps drilling it into everybody's head, every webinar, every letter. CCP companies are up 20% compounding. COVID ho, na ho, measles ho, na ho, doesn't make any difference. You gone out 20%, right? Ditto with the Kings of Capital, right? So just imagine how much hard work goes into that 20% earnings CAGR figure shown in the bottom left. In the last 5 years, we've had Demon, we had GST, we had Yes Bank, we've had ILFS, we've had Divan, we've had COVID. After all that, these franchises have gone down 20%, right? So that should be your broad return expectation, right? Let's not assume any PE rating, C rating, just simply on earnings compounding and looking at 20% compounding similar to CCP. Now let's look at volatility. So if you look now on the table on the top right, if you look at the back test, look at the standard deviation of the back test, right? It's around 29%, similar to Nifty. So what Kings of Capital is giving you is substantially better returns than the Nifty, 20% as opposed to the Nifty's 10, double the returns of the Nifty, with comparable volatility to the Nifty. However, CCP has half the volatility of the Nifty, right? So therefore, Kings of Capital and CCP should be broadly similar on returns. Given the drop in financial services prices, perhaps we get a little bit better return from Kings of Capital and CCP over the next 3-5 years. But broad volatility of Kings of Capital is twice that of CCP. That should be the working assumption. And therefore, our suggestion to investors will be, if you have invested 100 rupees in CCP, you should consider investing 50 rupees in KCP. If you've invested 100 rupees in CCP, you should consider investing 50 rupees in KCP. When we had LCP open, we were suggesting invest 33 rupees in LCP. That's because LCP simply didn't have that much liquidity, which is why regretfully we had to shut it to inflows. It's a beautiful portfolio, but unfortunately we had to shut it to inflows because liquidity nahi hai. We don't have that problem, thankfully, with KCP. Average market cap of a KCP stock is around 55,000-60,000 crores. But volatility of KCP will be similar to Nifty, twice as much as CCP, and hence, अगर आप 100 रुपए डाल रहे हो CCP में, consider putting 50 rupees in KCP. Back to you.
Right. So I think this is quite helpful. So now, Saurabh, I'll take, questions. You can maybe give short answers, because I'll take up, 6-7 questions. So first question is with regards to Reliance Industries. Since Reliance Industries has raised a lot of equity, and it is expected. So what is your take, right? So, we are wanting to understand from you, is it a positive aspect, that they have been kind of raising equity when debt could have been raised, which could have been raised at a much cheaper cost, or is it a sign of worry that they are unable to see profits coming into their business soon, and hence they're not raising debt and are kind of wanting to reduce their debt by kind of diluting their equity?
They're raising debt as well. No, they're raising debt as well. Some of the cheapest cost debt ever raised in India is being raised by them. So I don't think anybody should ever judge a country ki equity raise kar raha hai, debt raise kar raha hai. That's not a good way to judge a company. I think the way to judge a company, as we do for every portfolio, right? other accounts making sense? Right? If you do a 10-15 year forensic study, is the other account stacking? Is the company selling a product which is essential or a service which is essential to the Indian population? Thirdly, are there very high barriers to entry, as evidenced through return on capital consistently being higher than cost of capital? So there's only 20-25 companies in India pass that test, and they form basically our CCP and KCP portfolio. I'm sure Reliance in due course will become one such company with return on capital significantly higher than cost of capital. I'm sure one day Reliance will have a return on capital significantly higher than cost of capital, but it doesn't at the moment, hasn't in the last decade, and hence, we are conservative middle class investors. We are investing 3,000 Indian households' life savings, and therefore we can't speculate. We can't invest in hope, right? If we invested, Kamal, your life savings in hope, you will not, you'll not be talking to us anymore. You'll say, I might as well go to a Jyotishi. So we are conservative investors. We look for companies who over the last decade have given return on capital above cost of capital. I'm sure one day Reliance will also be on that list, but at the moment there aren't, and hence we haven't yet looked into the company in any. But my reading of the funding situation is they can do a debt, equity. The whole world is at their doorstep.
Right. So, and how does Reliance raising a lot of equity make you perceive about the banking and financial services sector? Because a lot of this money which is being raised is being perceived to be used to reduce their debt, and hence entire financial services sector, banking and NBFC sector, is supposed to benefit out of it. And if a lot of other companies also follow Reliance, then in that regards, in context to the topic of this session, which is financial services sector, how does that?
So financial services sector will have an immense opportunity, next 10 years. On the saving side, Indian households will need to save more money, right? After COVID, hopefully everybody's had the fright of their lives, and now savings rate in India will go up. Financial savings rate in India has already gone up in the last 3-4 months. Therefore, good life insurers, asset managers, wealth managers will make money. Kings of Capital will invest in them, has already invested in them, and we have already started to make money. Second is the weaker lenders, the weaker NBFCs, the weaker banks will go bankrupt. They will be decommissioned. And the stronger banks and NBFCs will make more money. Kings of Capital consist of strong banks and NBFCs, and hence we'll make money there as well. So nothing to do with Reliance here. Reliance is a great company. They'll go from strength to strength. We will carry on making money as the Indian economy, as the Indian financial services sector goes from being a fragmented sector to a consolidated sector.
What is the meaning of concentration in Kings of Capital? So what is the number of stocks that you are foreseeing this portfolio will have?
Tej, do you want to answer that?
Yeah, we'll have 10 to 14 stocks. We're starting off with 12 stocks, median market cap of about 55,000 crores. And this will be about 35-40% in non-lenders, which will be insurers, asset managers, brokers, about 60-65% in lenders. We're starting off with 12 stocks. So this is it. About 55,000 crores market cap, and well diversified within multiple verticals of the financial services industry.
Right. Right. So, and given that we are still on with the threat of COVID, as number of cases have been rising, what is the time horizon that you recommend investors who come into your portfolio? Because there could be a possibility of short-term volatility, short-term movement in the negative movement over 2020. And what are your views in this regards?
So Tej, if you don't mind, just show that slide again, after the share price drop wala slide we showed. No?
Yeah.
So look, I think we've never said in any portfolio, Marcellus has never raised money saying we are trying to play the next 1 week, 1 month, 1 year, right? We've always told our clients, take a 3-year view. In all our books in Coffee Can Investing, Rakshit and I've clearly said, take a 3-year view, otherwise stay away from equities, right? So nobody out there should even consider investing with us if they are thinking about 1 week, 1 month, 1 year. Take a 3-year view, otherwise, don't invest in equities. Don't even invest in any index if you can't take a 3-year view. With regards to COVID, you can see the share market is telling you its own story, right? So So the black line in the chart on the top left, the black line is Nifty banks. You can see Khatak, it falls in January, February, March, and it is nowhere near. Nifty banks is nowhere near where it was in January, still 20% shy. What Tej has done is he's shown you the lenders and the non-lenders separately. So the non-lenders are the green. The non-lenders are sorry, the panel is a little small. The non-lenders are the blue line. The non-lenders are the blue line, and hence they are somewhere back to where they were in January. So this is say HDFC Life or ICICI Lombard, somewhere back to where they were in Jan. The lenders are, this is the best lenders in the country, the kings of capital lenders. The green line, we're still 20% shy. So hopefully anybody out there who tends to lose sleep on valuations, you're not worried about the valuations of an HDFC Bank and Kotak Bank at these levels, because if you are, then I'm afraid you should consider migrating to other countries. If you can't buy HDFC Bank, Kotak Bank, in the current circumstances, given the strength of these franchises, the quality of their management teams, and the evident benefit COVID confers to them. Yeah, so I was just saying that I think COVID, the death toll in the big cities is already down to very low numbers. And thankfully, we are testing more. As we are testing more, the active cases are going. But I don't think anybody other than media people are losing that much sleep about it. We will test more people. And as we test more, there will be more active cases. But the main metric to focus on is death toll. The death toll has dwindled, which is immense credit to our medical community. I think we should all be equal to the COVID warriors out there, whether in public sector hospitals or private sector. Medical profession has done a stellar job of streamlining medical protocols. Ventilators are abundantly available. Remdesivir is abundantly available. And the worst of the COVID threat really is 4-5 months behind us. Russia has become the first country to announce a vaccine. God willing, have a vaccine before Christmas. So if you think you're still losing sleep on COVID, I don't think we can do much to give you comfort. I think I would just recommend read good newspaper every day to give you a realistic either. Indian Express is the newspaper I read. Strongly recommend it.
Right, Saurabh. So another question is with regards to one of your strategies, Little Champs. What is the reason behind shutting that strategy? Why you have stopped taking funds in that strategy?
Pramod, can you answer that?
Yeah, sure. So Little Champs, as you know, the two things to note. One is, as you've seen consistently with all our portfolios, the portfolio size has been 10 to 15 stocks. It's a sweet spot for us. We believe that below 10 stocks, maybe there's a bit too much of concentration. Beyond 15 stocks, we don't see any benefit or incremental benefit of diversification coming through. And also 15 keeps it nice and tight for a team of 12 research people like us. It allows us to monitor these stocks to a fairly high depth, even after buying those stocks, which is perhaps more important. Given that we're comfortable with 15 max, the sort of portfolio we've built up for Little Champs is now with an average market cap of something like 2,000 crores. The important thing of small caps is not just finding good quality small caps, but also your position sizing such that you don't take undue liquidity risk, right? So we don't want to have too much of a stock exposed, or too much of the funds exposed to a single stock. So for us, 1% of shares outstanding is a comfortable limit. 1% of 2,000 crores gives you an average position size of 20 crores. 20 crores into 15 stocks is a 300 crores. That's the way we see as the capacity of the fund. And this is very, very important to appreciate, because that's looking around in the industry, that seems to be the most common mistake most people make, which is while the going is good, everybody wants to give you the money, but it's important to know when to say no and stop taking money and appreciate the capacity of your strategy, because every strategy has a capacity at the end of the day. And in my view, I have lots of friends in the mutual fund industry. Lots of them have been our esteemed clients over the last 10, 15 years, very capable managers. It's just that they're now running funds which are significantly large. Despite their best efforts, it's very difficult to deliver a decent return. Like Saurabh said, there are a handful of companies which are in that small intersection of not just clean accounting and clean governance, but also competitive advantages and capital allocation. It's a very, very small intersection. If you are to build a portfolio of such a small set of stocks, you can't be running too large a fund. And therefore, from a fund manager's perspective, that's the dilemma you have to face. it's nice to build large funds and get more fees, but at the same time, if it comes at the cost of the returns for the investors, it defeats the whole purpose in the first place. So we made that promise to investors that we'll stop taking money after we reach the 300 crore number. Hopefully, investors have seen that play out in front of their eyes as we shut the fund for fresh inflows.
I think by the same token, it behooves us to thank those investors who reposed faith in us. Remember, we started raising money for Little Champs back in August last year. Right, August last year, most people told us, "You're mad. You're raising a small cap PMS. It's not going to work." So, your clients, Kamal, PMS, AIF clients, repose their faith in us. We thank those people who entrusted us their money through 2019, through the COVID months, and we'll work very hard over the next 3, 4, 5 years to give good returns. That will remain the Marcellus philosophy. We don't really care what's happening in the world outside. Whatever nonsense is spoken, keep focusing. Clean franchises, essential products and services, and dominant business. Right? Do that through bull market, bear market, COVID, measles.
Right. And, just to compliment and acknowledge that, yes, those investors who had invested in Little Champs are already sitting on 18 to 20% returns in 2020. So this is one last question with regards to, stocks which are expected to come in, Kings of Capital. Obviously, we are not asking what are the stocks, but there are a lot of people who are sharing questions on chat where they are saying that, can one assume that those 4 companies which are there in, considered compounders will also be there in Kings of Capital?
Yes, so as I think Tej has mentioned, it's a 12-stock portfolio. So yes, 4 of them are taken from PCP. There are 8 other companies which are conceived.
Right. And there are a lot of other companies and NBFCs which we see in a lot of other advisory services and a lot of other portfolio management services, which are like popular names these days, like Ujjivan Finance, Muthoot Finance, MCX, right? Everybody markets them, giving a lot of logics. So what are your views in this regard?
So Kamal, I'm sure you know what happens to those sorts of stocks when they go through the Marcellus filtration process. Tej is a very hard taskmaster, and only the best make it through a filtering process.
Sure. Right. And what is your view, with regards to, in life insurance as an upcoming sector? Many mutual funds as well as many portfolio management services have over last 6 months added a lot of life insurance company stocks. There are handful of names. So if you have to give your perspective on life insurance,
Tej, would you like to volunteer your sector view on life insurance?
Yeah. Like you said, we have HDFC Life in CCP as well, and this is we believe the best life insurer in India. What's happening in life insurance is that over the past 10-15 years, they've primarily focused on ULIPs as a product. Now, as the insurance sector is maturing, as rules, regulations, laws have become pretty clear, pretty stable, there's a lot of innovation which is happening not only in terms of products, but also in terms of distribution channels when it comes to life insurance. Now we've picked the best insurer when it comes to distribution channels, when it comes to innovation, capital allocation, and the products being offered to customers. So what we see in HDFC Life, we don't see this in any other life insurer. Maybe the sector, so the sector is going to grow. Like we discussed, that savings is going to be, financial savings is going to be large opportunity going forward, a good structural play. So the sector is going to grow, but the company which is well positioned, which has high barriers to entry when it comes to innovation, the DNA around big data, technology and analytics, and the DNA around a good product mix, a good channel mix is HDFC Life. So while other insurers might or might not grow, HDFC Life will not only grow along with the sector, but will also rapidly gain market share because of the way in which it has invested in technology, because of the way in which it is well ahead of the curve when it comes to product innovation. So no other company, for example, started off doing protection or annuity products 5-6 years ago. Reinsurance as a market, no one is talking about right now. HDFC Life has a large reinsurance subsidiary. Private pension fund management, HDFC Life is the largest in that space as well. So these are sectors which we'll come to know about 5-10 years from now. People will maybe start talking about these spaces within the life insurance sector 5-10 years from now. But HDFC Life is well positioned for the growth in these sectors whenever it comes at a large scale.
Right. Saurabh, this is another question for you. Is the percentage of subsector allocation within Kings of Capital decided already, or it is yet to be decided?
So the portfolio is underway. There are several clients who already invested. I've also already invested. So portfolio is underway. Tej, if you could just give a broad sense of sector allocation.
Yeah, so what is decided is the split between lending and non-lending as of now. We've invested, the portfolio is decided. We've already invested our clients' money in the portfolio. 12 stocks are decided, allocation is decided. 60-65% is lending, 35-40% is non-lending. So that is the overall split.
Sure. Right. And this is the last question, which is a question which I think has been asked by a lot of your fans, Saurabh, who I do not know if are able to invest or not, because there is a minimum ticket size of 50 lakhs in a PMS. But since you have added a lot of fan following, this question in that regards, and also since you are on board of SEBI with regards to you giving them a lot of perspective about the industry, and SEBI finally has been able to decide their advisory guidelines. Well, can this be expected that Marcellus will also launch an advisory model portfolio for less than 50 lakhs as an amount, maybe in year 2020 or 21? Are you thinking on those lines?
So I'll request Pramod to comment on that advisory product. What I would like to say to all our well-wishers out there is we put in a lot of effort in the newsletters, in the blogs that we get are published on a weekly basis, which anybody can subscribe. If you go to marcellus.in, you can subscribe to our newsletters, blogs, there is charge associated. Anybody can do that. A lot of research and effort goes into our webinar. And as a result of all this material out there, plus our books, Unusual Billionaires, Coffee Can Investing, on Monday, Victory Project will be published. Our latest book will be published on Monday. On Amazon, you can find our book on crisis investing. Basically, we try to give you a very good sense of our stocks, of our investing process, so that you out there can basically benefit from this and build your own portfolios using the intellectual property that we are putting out there completely free of charge. So we appreciate that we have a responsibility to the country at large. The country has given us a lot. We have privileged lives. We have the privilege of managing the money of many of you on this call. We try to do what we can to make sure that we give back whatever knowledge God has given us, we give it back to you. On the specific issue of can we launch an advisory product for people below 50 lakhs, I'll request Pramod to give his thoughts.
Well, we've considered that, and in our past experience, we haven't found that particularly sticky, because it might work with a product where there's a pretty high turn ratio. Like Saurabh mentioned, you actually don't need us to run a portfolio on your own. In our case, because the churn is very little, in our case, most of the portfolios are publicly known. I'm told that there are lots of versions of the portfolio running on Twitter and WhatsApp, and also why would you want to even pay us anything to do that? Having said that, the better way to do it yourself is in the books, the frameworks that are given in the books, as opposed to doing it, because the advisory construct, we don't think gives us the complete fiduciary responsibility over overseeing your capital. Would prefer a construct where we have the capital with us and we take complete responsibility for that, rather than just giving you the advice and not bothering about it. So far, that's the preferred route. If that changes in future, PMS AIF will be the first to know.
In fact, echoing Pramod, I've seen myself on social media. I'm on LinkedIn. I've seen myself on social media. There are several investment advisors and PMS providers who earn a living by copying our portfolios, and we don't charge them a single penny. So because our material is so widely out there, there's a whole mini industry, cottage industry, which has mushroomed around copying our portfolios, and all part of them, if they can democratize our investment process, if they can democratize our investment process and take it further into the country will be better for it, the financial system will be better for it, more wealth will be created.
Right, Saurabh and everybody from Team Marcellus. Thank you so much for spending your time.
And thank you for taking the trouble to organize this, and take care, sir.
So this we have been doing, every week. This is Advice Sense Knowledge series. So it was an insightful experience talking to everybody. Thank you everyone to join. Thank you.
Thank you.
Thank you.